You might actually be sitting on a massive hidden tax bomb, and you probably think you aren't even rich enough to trigger it.
Oh, yeah. It happens all the time.
Right. So welcome to the Deep Dive. Our mission today is pulling back the curtain on how high net worth families, structurally protect their legacies.
And why those exact same strategies are suddenly highly relevant to people who would never dream of calling themselves ultra-wealthy.
Exactly. We are pulling this roadmap from a really comprehensive guide called Protecting Generational Wealth. 7 estate tax planning strategies every Florida family needs.
And this comes to us from Davies Wealth Management. They're a fee-based fiduciary advisory firm out of Stuart, Florida, originally featured on the 1715 Treasure Coast Financial Wellness podcast.
Yeah, and if you are listening right now thinking, I don't live in Florida, and I'm definitely not a billionaire, so I'm going to skip this one. Hold on.
Please don't skip it.
Yeah, because we are going to look at the actual mechanics of wealth preservation. And as you'll see, your estate might be significantly larger than you realize.
Well, the catalyst for this entire conversation is this monumental shift in the legal landscape that just occurred. On July 4, 2025, the One Big Beautiful Bill Act was signed into law.
The OBBBA.
Right, the OBBBA. What's fascinating here is how OBBBA completely altered the psychology of estate planning.
How so?
Well, for the last several years, families and their wealth managers were essentially operating under a state of, low-grade panic.
Because of the sunset provision, right?
Exactly. They were staring down a sunset provision from the old Tax Cuts and Jobs Act,
Yeah.
which basically meant federal estate tax exemptions were scheduled to get slashed in half overnight.
Wow.
So people were rushing into complex legal structures just to beat this arbitrary countdown clock.
But OBBA removed that cliff entirely, didn't it?
It did. It permanently set the federal estate and gift tax exemption at $15 million per individual.
Okay, so for a married couple, we are looking at a $30 million shield.
Taking effect on January 1st, 2026. And it's indexed for inflation. When you remove artificial panic from financial planning, you get vastly superior structural decisions. Wealthy families can now build their defenses from a position of absolute certainty.
They don't have to scramble anymore.
No, they can intentionally design frameworks that compound over decades.
Okay, let's unpack this $30 million number. Because if you hear a limit that high, the natural reaction is to just assume you are completely off the hook.
Oh, for sure.
Like, you think about your checking account, maybe your 401k, and you figure, hey, I have miles of breathing room.
Right, but the Davies Wealth Management Guide identifies this as one of the most dangerous blind spots out there.
Yeah, they call it the accidental large estate.
People consistently conflate their liquid cash with their total taxable net worth. And, the IRS does not view your wealth the way you do.
No, they definitely don't. So if I'm not a multimillionaire, I shouldn't just tune out. Let's look at the specific example they outline in the guide, which paints a very vivid picture of an upper-middle-class professional family.
It's a great example.
Let's say a couple lives in Florida. Over a lifetime of hard work, they own a primary home valued at $2 million.
Okay.
And they've been diligent savers, right? So they've accumulated $3 million in their retirement accounts.
Which is fantastic.
And they built a successful local business, maybe a mid-sized logistics company or like a dental practice valued at $5 million. And because they're responsible, they carry a $2 million life insurance policy.
Right. So if you stop that couple on the street and ask them their net worth, they would probably point to the $3 million in the bank.
Exactly.
They don't conceptualize the business they work at every day or the roof over their heads as liquid wealth. But when they pass away, the IRS throws a huge net over everything.
Over the house, the business, all of it.
The retirement funds, and yes, even the death benefit of that life insurance policy.
Wait, really? The life insurance too?
Oh, yeah. The IRS looks at that couple and sees a $12 million estate.
Which is already staggering. I mean, you just lived a successful professional life, and suddenly you're an accidental decamillionaire on paper.
Yep.
Now, fast forward 10 years. Add normal historical market appreciation to that real estate, compound growth to the retirement accounts, and natural expansion to the business.
It balloons quickly.
Suddenly, that $15 million individual threshold isn't some distant galaxy. It is right in the rearview mirror.
And remember, federal taxes are only one layer of the threat. Florida is well known for not levying a state-level estate tax.
Right, which is why people move there.
Sure. But the guide emphasizes that if your heirs reside in, or if you happen to own property in, states that do enforce their own estate taxes, you're still exposed.
Oh, I hadn't thought of that.
Yeah, some of those states have exemption thresholds as low as $1 million. So your $30 million federal shield won't help you against a state tax department aggressively pursuing, say, a vacation home in a high-tax jurisdiction.
Not to mention the pure administrative nightmare of probate.
Oh, probate is the worst.
Yeah. Even if you miraculously dodge all federal and state taxes, leaving assets unstructured means they go through the public court system. It's incredibly slow, notoriously expensive, and anyone can look up exactly what your family inherited.
Exactly.
So the question becomes, how do I build a baseline defense to protect that accidental wealth?
Well, the foundational layer of defense is ensuring you don't inadvertently surrender the tax shields the government already provides.
Okay.
And the most crucial of those is a concept called portability.
I really like how the guide frames portability. It's strategy 1, right?
That's right.
It's essentially the exact same mechanism as rolling over your unused cell phone data to your spouse's plan at the end of the month.
That's a perfect way to look at it.
So if one spouse passes away and they only used, say, $5 million of their $15 million OBBA exemption, the surviving spouse can absorb that unused $10 million.
Right. It stacks on top of their own $15 million, creating a massive combined shield.
But there is a catch, isn't there?
A huge one. The structural logic is brilliant, but it contains a massive, frequently overlooked trap. The IRS does not automatically grant you that rollover data.
You actually have to ask for it.
You do. To capture the deceased spouse's unused exemption, the surviving spouse, or the executor, must file a formal federal estate tax return.
Form 706.
Yes, Form 706. And you have to do it within a strict time frame. You have to file this comprehensive, highly complex tax return, even if the estate owes absolutely zero tax at the time of death.
That is a terrifying technicality. I mean, when a spouse passes away, the very last thing a grieving family is thinking about is hiring an accountant to file a preemptive tax return for an estate that doesn't owe any money yet.
Nobody thinks to do it.
But if they miss that filing window, that unused $15 million exemption just evaporates.
It vanishes completely.
Yeah.
And that administrative oversight ties into another foundational vulnerability, which is mistake #2 in the guide ignoring beneficiary designations.
Oh, this one is huge.
People will spend thousands of dollars retaining an attorney to draft an airtight, beautifully complex will. They lock it in a safe and assume their legacy is secure.
But a will does not dictate where the majority of modern wealth actually goes. Right?
Exactly. Retirement accounts, IRAs, life insurance policies, they all move via beneficiary designation forms.
And those forms legally supersede whatever is written in your will.
Yeah, absolutely do.
So you could draft a new will tomorrow, leaving everything to your current spouse. But if your 401k still lists an ex-spouse from 20 years ago on the company portal, that ex-spouse is getting a very large, completely legal windfall.
We see this fracture, carefully designed defensive structures all the time.
Really? Just from a forgotten form?
Yeah, a family might create a sophisticated trust specifically to shield their children's inheritance from future creditors or divorces. But then they casually list the children as direct individual beneficiaries on a life insurance policy rather than listing the trust.
Oh, so the money bypasses the protective legal structure entirely and drops straight into the kids' vulnerable bank accounts.
The entire defense unravels because of a single unchecked box on a PDF.
Wow. Okay, so assuming the baseline is secure, we filed Form 706. We synchronized our beneficiaries with our legal documents.
Right, baseline is set.
But what happens when the underlying assets, maybe that local logistics company or a real estate portfolio, are just growing too aggressively? Like, if you are going to blast past that $30 million ceiling, the next logical phase is shrinking the target while you are still alive.
This is where we move from defensive posturing to proactive reduction.
Okay.
The most straightforward method is strategy 2, which is systematic annual gifting. Now, we aren't talking about handing out cash envelopes at holidays.
Right, not just $50 in a birthday card.
No. High Net Worth Wealth Management treats gifting as a highly calibrated pressure release valve. You are intentionally siphoning off the overflow before it can compound inside your taxable estate.
The guide details some incredibly powerful ways to do this. For example, superfunding 529 college savings plans allows you to front-load 5 years' worth of tax-free gifts into a single massive contribution.
Which is a massive advantage.
Or, better yet, making direct payments to institutions. Like, if you pay your grandchild's university tuition directly to the school's bursar, or you cover a massive medical expense by paying the hospital directly, the IRS completely exempts it from gift tax limits.
It doesn't even dent your annual exclusion allowance.
Yeah.
It is structurally highly efficient.
Yeah.
The tax code is essentially rewarding you for subsidizing education and healthcare. But the real leverage comes when you apply advanced trust structures to assets that haven't exploded in value yet, but you know they will.
Here's where it gets really interesting. This is strategy 4. The guide breaks down a tool called a grantor retained annuity trust, or a GRAT.
The GRAT, yes.
Let me see if I can map out how this actually works. Say I own stock in a tech startup that is about to go public. I take that highly appreciating stock and place it inside this irrevocable trust.
Yep, you lock it in.
And the trust is legally required to pay me back a fixed annuity every year for a set term. When that term ends, whatever growth occurred above a specific IRS-mandated interest rate goes to my kids, completely free of gift taxes.
That's the basic mechanic, yeah.
When I first read this, it sounded like a blatant loophole.
It feels like a loophole, for sure.
Yeah.
But it is a deliberate mechanism engineered by the IRS, relying on their own internal math.
How so?
Well, if we connect this to the bigger picture, every month, the government publishes the Section 7520 hurdle rate. This is the baseline return the IRS assumes an asset will generate.
Okay.
Let's say that rate is currently sitting at 4%.
So the IRS assumes my startup stock is only going to grow by 4% a year.
Correct. You put the stock into the DRAT. Over the term of the trust, it pays you back your initial principal, plus that assumed 4% interest. From the IRS's perspective, this is a zeroed-out transaction. You haven't actually gifted anything of value to your heirs because you received the principal and the expected growth back in the form of annuity payments. There is zero gift tax triggered.
But the reality is it's a pre-IPO tech company. It didn't grow at 4%.
Exactly.
The company went public and the stock surged by 50%.
And that is the magic of the structure.
Yeah.
The IRS already signed off on the transaction based on their 4% assumption.
So the rest is just free.
That explosive 46% margin of excess growth flows out of the trust and directly to your children. You have successfully transferred massive generational wealth entirely outside the estate tax system.
That is brilliant for a liquid asset like stock, but that brings us to what I'm called the illiquid dilemma.
Right.
What happens if the vast majority of your wealth is bolted to the ground? You can't easily chop up a massive commercial warehouse or an active manufacturing plant and slide it into a garage.
No, you definitely can't.
You run into a severe liquidity crisis. And the Davies Guide points out that a major culprit here is, surprisingly, life insurance.
Yeah, as we established earlier, the IRS includes the death benefit of life insurance in your taxable estate if you maintain ownership of the policy.
Which most people do.
Right. If you hold a $10 million policy, your estate just got $10 million heavier on the tax scale.
So the structural fix for this is strategy 3, an irrevocable life insurance trust, or an ILIT.
Exactly.
And the logic is beautifully simple. I don't own the policy. The trust owns the policy.
Right, you separate yourself from it.
I pay cash into the trust pays the premiums. When I pass away, that $10 million payout doesn't land in my taxable estate. It lands inside the trust, and that solves the illiquid dilemma instantly.
It acts as an immediate tax-free reservoir of cash for your heirs.
Because they might need that cash to pay taxes on the other stuff.
Precisely. Because if your family's wealth is entirely locked up in $80 million worth of illiquid real estate, and the IRS demands a $20 million estate tax payment due in exactly 9 months, your heirs are trapped.
Without an ILAT providing instant cash, they are forced into a distressed fire sale.
And that is a tragic way to lose generational wealth.
They'd have to liquidate family properties or sell off the family business to private equity at a brutal discount just to satisfy the tax man.
Right.
And speaking of the family business, I want to connect this to strategy 7, which is business succession. The guide stresses that protecting the company requires a very specific toolkit.
It really does.
If the business is the estate, a lack of structural planning doesn't just trigger taxes, it triggers family civil wars that can destroy a 30-year enterprise overnight.
Business succession at this level of wealth goes far beyond simply naming the next CEO.
Oh, definitely.
It requires isolating the business from the personal estates of the founders. And one of the most effective ways to achieve that is by utilizing family limited partnerships, or FLPs, alongside family limited liability companies.
The concept of valuation discounts with FLPs is incredible. Let me try to explain the mechanism here because it relies on a very specific legal interpretation of value.
Go for it.
If I own 100% of a family hardware chain, I have total control. I can liquidate it, pivot the business model, sell it to a competitor, whatever I want.
Right, you're the boss.
And that total control commands a premium price on the open market. But if I place that company inside a family limited partnership and I gift my children a 10% minority share, they have zero voting rights.
Not at all.
They cannot force a sale. They cannot influence the board.
So from a valuation standpoint, you have severely handicapped that 10% share. If your child tried to sell their non-voting restricted share of a family-controlled hardware chain to an outside investor, that investor would demand a massive discount because the asset is highly illiquid and lacks any operational control.
So the IRS legally recognizes that a 10% slice of the business is actually worth significantly less than 10% of the company's total paper value.
Exactly. By intentionally fracturing the ownership and removing control, you compress the taxable value of the asset while keeping the actual wealth entirely within the family walls.
It is a profound demonstration of how tax law differentiates between intrinsic value and marketability. You are utilizing the IRS's own rules regarding restricted assets to shrink your taxable footprint.
It's a very elegant solution.
So we've insulated the spouse with portability, we've transferred rapid growth with GRATs, we've created cash reservoirs with ILETs, and protected the business with FLPs.
We've covered a lot of ground.
But what about extending that structural defense beyond the immediate family? Like, what if the goal is philanthropy or protecting unborn great-grandchildren?
That's where Strategy 5 comes in.
Right. The roadmap outlines charitable remainder trusts, or CRTs, for exactly this purpose. This is the perfect tool for a family holding a highly appreciated asset.
Like a piece of raw land they bought decades ago that is now in the path of development.
Exactly. They want to sell it, but the capital gains hit would be catastrophic.
A CRT solves the capital gains problem by transferring the asset's ownership to a tax-exempt charitable structure before the sale occurs.
Oh, before the sale.
Right. The trust sells the land. And because the trust is a charitable entity, the massive capital gains tax is bypassed entirely. The trust then takes that untaxed pool of capital, invests it, and pays you a steady income stream for the duration of your life. When you pass away, the remainder funds the charity of your choice, and your estate receives a charitable deduction.
So the family gets a lifetime income stream, the charity gets a massive future endowment, and the asset is removed from your taxable estate.
That's a win-win-win.
That really is. And for listeners who are 70 and a half or older, the guide highlights a much simpler, incredibly efficient philanthropic tool, qualified charitable distributions, or QCDs.
The mass market financial industry chronically underutilizes QCDs.
Why is that?
Well, people just don't know about them. Once you reach a certain age, the government mandates that you begin withdrawing money from your traditional IRAs. These are required minimum distributions, or RMDs.
Right. The government wants their tax money eventually.
Exactly. And those mandatory withdrawals get stacked on top of your taxable income, potentially pushing you into a higher tax bracket or triggering surcharges on your Medicare premiums.
But a QCD allows you to bypass your personal tax return entirely, right?
Completely.
You direct the IRA custodian to transfer those funds straight to a qualified charity. It satisfies the government's mandatory withdrawal requirement, but the money is completely invisible to your adjusted gross income.
It is precision tax mitigation.
I love that phrase.
Now, when we look past philanthropy and focus on designing a legacy that spans generations, we have to examine Strategy 6 and why this specific guide originates in Florida.
Right, the dynasty trusts.
Florida possesses a unique jurisdictional superpower regarding dynasty trusts.
A dynasty trust is engineered to shield wealth across multiple generational leaps, from children to grandchildren to great-grandchildren, without the estate tax taking a massive 40% bite every time somebody passes away.
Which is how it normally works.
Right. But historically, the legal system absolutely hated the idea of wealth being locked away indefinitely. They enforced a concept called the rule against perpetuities.
A very old legal concept.
Yeah, which essentially forced trusts to eventually dissolve and distribute their assets, throwing the wealth right back into the taxable crosshairs.
But several states, with Florida being a premier destination among them, functionally repealed the rule against perpetuities.
They just got rid of it.
Basically.
Yeah.
They recognized that wealthy families were seeking jurisdictions that allowed for infinite compounding.
Which means a dynasty trust legally anchored in Florida can theoretically operate forever. The underlying assets sit inside the protective shell, compounding tax-free.
Bro.
They are largely insulated from estate taxes generation after generation, and crucially, they are walled off from the beneficiary's own personal liabilities.
Which is huge.
Whether that's a failed business venture, a bankruptcy, or a future divorce, it is the ultimate architectural foundation for a permanent family legacy.
And this sheer complexity brings us to the operational reality of executing these strategies. You cannot deploy DRATs, ILATETs, and multi-generational dynasty trusts using a mass-market retail brokerage account.
No, definitely not.
The guide makes a compelling argument for the necessity of a fee-based fiduciary.
The distinction is critical. A standard broker is often incentivized by product sales, moving mutual funds or selling specific insurance policies.
Right, they be commissions.
But generational wealth preservation is an interdisciplinary operation. It requires a quarterback. You need a central fiduciary whose sole mandate is coordinating your CPA, your estate attorney, and your portfolio managers.
Someone has to make sure the legal architecture perfectly matches the financial realities on the ground.
Exactly.
And this raises an important question. If that coordination breaks down, you fall into the most dangerous trap of all, which is mistake #1 in the guide. Treating estate planning as a set-it-and-forget-it transaction.
Oh, yeah. You can't just put it in a drawer.
No, the guide emphatically states that these structures must be stress-tested and reviewed at least every 3 years, or immediately following any major liquidity event, death, or divorce.
Things change.
A trust structure that was mathematically brilliant a decade ago might be functionally obsolete today due to a minor shift in tax court rulings.
And without that interdisciplinary team talking to each other, you might walk right into a devastating unforced error.
Like mistake #3.
Yes. The final warning in the Davies Guide surrounds the concept of step up in basis, and this perfectly illustrates why you need tax and legal professionals reading from the same playbook. Let's break down how basis works, because it flips the logic of gifting completely upside down.
Okay, so cost basis is simply the original price you paid for an asset.
Right.
Imagine you bought a parcel of real estate for $100,000, and over 30 years, it appreciates to $1 million. You have $900,000 of embedded capital gains.
That's a lot of gain.
If you sell that property while you are alive, the IRS will tax you heavily on that $900,000 gain.
Naturally.
However, the tax code includes a powerful provision for inherited wealth. If you hold that property until the day you die and leave it to your children, the cost basis legally steps up to the current market value of $1 million.
The tax code essentially hits the reset button on that value. The $900,000 of historical growth is completely wiped clean from a capital gains perspective.
Completely erased.
Your kids could sell the property the day after they inherit it for $1 million and pay absolutely zero capital gains tax.
Which highlights the hidden danger of proactive planning. A well-intentioned parent might aggressively gift that property to their children while they're still alive, thinking they're successfully removing a $1 million asset from their taxable estate.
Oh, I see where this is going.
But by transferring it while alive, the step-up provision does not apply. The parents just inadvertently transferred the massive $900,000 tax burden to their kids.
Oh, no. So they optimized for the estate tax, but created a capital gains catastrophe.
Exactly. It's a multi-dimensional chess game. You cannot make a move on the estate tax board without calculating the capital gains reaction.
So what does this all mean? When we pull back and survey this entire landscape, from the foundational mechanics of portability to the advanced architecture of FLPs and dynasty trusts, the ultimate takeaway from the Davies Wealth Management Guide is a shift in mindset.
A massive shift.
Thanks to the permanent $30 million limits established by OBBA, wealth preservation is no longer about panicked reactions to arbitrary deadlines. It is about highly intentional structural design that leverages time and compounding to your advantage.
But constructing that architecture introduces a profound psychological friction.
What do you mean?
Well, mathematically, tools like GRATs and irrevocable trusts are breathtakingly efficient at shielding wealth. But they all demand the exact same sacrifice from the creator.
Which is?
They require you to irrevocably surrender control of your assets today in exchange for a tax benefit tomorrow.
Wow. Yeah, that is an incredibly heavy psychological lift for someone who spent 40 years building a business or assembling a real estate empire with their own two hands.
It is.
Asking them to place it in an irrevocable box where they can no longer touch it goes against every instinct that made them successful in the first place.
It forces a deep internal confrontation. You have to ask yourself, are you holding on to these assets out of a genuine, calculated need for operational control and personal security? Or are you simply gripped by a lifelong, deeply ingrained habit of accumulation?
That's a powerful question.
Because mathematically, the legal frameworks exist to protect your family's future. Quite often, the most formidable barrier to generational wealth preservation isn't the tax code. It's finding the courage to let the next chapter begin while you are still here to witness it.
Take a close look at the reality of your own estate. Audit those beneficiary forms. Calculate the true value of your illiquid assets and start building your structural defense before the burden becomes too heavy to carry. Thanks for joining us on this deep dive. We'll catch you next time.